Today is Friday, the 19th of December. I hope everyone is doing well. Before I end this call, I just want to make sure that I wish everyone a very Merry Christmas and a very blessed New Year. It's been a challenging couple of years in the real estate world, but y'all, we have been so blessed to have so many repeat customers, so many loyal referral partners. It's been actually pretty good for us, and we're very thankful for that because we know that's not the case everywhere. We hope everyone has a banner 2026, and we are certainly looking forward to that. I think we may be seeing lower interest rates throughout the year in 2026. So let's get right in and look at where the national averages are today and talk a little bit more about where they've been over the last 12 months. Mortgage News Daily has a 30-year fixed rate conforming loan today at 6.25%. Not too far off the lows of the year, y'all. We're going to look at that in just a second. A week ago, we were at 6.32%. A month ago, we were at 6.36%, again, according to Mortgage News Daily. M&D had the national low recorded on September 16th. We hit 6.13%, not quite an eighth of a point below where we are today. You have to go all the way back to January 13th to find the high of the year. We were at 7.26%, y'all, exactly just a hair less than a full point higher than we are today. If you look at a bond chart that shows where prices in bonds have been and try to correlate those to Fed meetings, y'all, you don't see a distinct correlation. In fact, you see after the last 3 Fed cuts, interest rates popped a bit higher, except for this last one. We did see a little bit of a benefit for 2 days, and we've seen bonds a little bit better priced since this most recent cut. I will tell you it's due to economic data after the cut, not the cut itself. The reason for that, as we've mentioned many times on this call, the Fed does not control long-term interest rates. They certainly don't set mortgage rates. All right. Got some great news yesterday on the inflation front, y'all. Core inflation, 2.6%. 3% was expected, y'all. We know there was not a single prediction out there that had us at 2.6%, lower than every expectation on the core rate. The headline was also lower than expected, also anticipated to come in at 3%. That's the number we were replacing, came in at 2.7. Again, no estimates out there had us that low on either the headline read or the core read on inflation. The Fed can no longer point to inflation or fears of tariffs impacting prices in a way that stymies future cuts. They just shouldn't. They probably will, but they shouldn't. We are sitting very much at goal, or pretty close enough to goal to where the Fed shouldn't be using inflation as a reason to not cut. When you look at the Fed Watch tool, though, y'all, the Fed is expected to be stubborn at the January 28th meeting. There is only a 22% chance of a cut, according to Fed futures trading today at that January 28th meeting. I would have thought we would see improvement. Actually went the opposite direction after that weaker than expected CPI number. It's going to be interesting to see how that shakes out. There is now a 56% chance of a cut on or before the March 18th meeting, however. So the odds of that March 18 meeting are starting to pick up a little bit, but the odds of a January 28th cut are starting to get priced out of the market rather than in, even though we got that great read on inflation. We'll see if that changes in the coming weeks. It's not just inflation, though, that should be giving the Fed a reason to cut. We have seen further weakness in the jobs numbers, y'all. In fact, you have to go back to July to see the last time, actually the June read, before you see an unemployment rate that was flat or lower. We have seen the unemployment rate starting in July of this year go from 4.1% to a current 4.6% based on the numbers we got last week. That means that we have seen increases in the unemployment rate at every meeting for the last 5 months, y'all. So there is weakness in the jobs front. There is control on the inflationary front. The fears that the sky is falling because of tariffs has not materialized. We've talked about that on numerous previous videos, y'all. Don't want to go back into all the mechanics of that, but we are seeing kind of the perfect benefits of both mandates that the Fed is charged with that should set us up for lower pricing in 2026. That's going to be a good thing, y'all. Does that mean that you wait to lock in a rate? No. I think you ought to grab every little bit of improvement, lock that down, maybe buy some discount, because we've talked on previous videos about how much discount you can buy when rates are anticipated to come down long term versus when they're not. If we were in an escalating rate environment, y'all, those discount points don't buy you much at all. But in a declining rate environment, you see a lot of bang for the buck, and it's definitely worth looking at because you might just be able to buy down a rate sufficiently to where you're not going to see rates that low to tempt you for a refinance and the cost of it at any time in the near future. So those are conversations I love having with folks, y'all. Let's run the math together. I've got all the tools to make it really understandable for you and for your clients, and always love doing that, y'all. I'm a numbers nerd and I enjoy them. So in any event, always blessed to have your referrals. Again, stay blessed, stay safe this holiday season. We look forward to working with you in 2026 and continuing to do so. And we just are so thankful for all of you. Have a blessed week. We will talk to you soon.